UK, with the energy crisis, that's been kind of a negative shock, whereas the US has actually benefited from that, being a net exporter of oil and gas. So that's another factor that drives that difference in productivity. But I think in general, I also wanted to note that if we look at the productivity estimates that the OBR have in their long run productivity, they've actually revised it up since last time from roughly 1.67 to 1.75, which was actually a surprise to markets because the level, the trend growth rate of productivity is above the range of estimates. I think it's chart 2.21 of the external forecasters, and you actually see from 2026 the OBR line is well above the range of external forecasters. So that is something where it feels like, well, what is that on the basis of? And I was actually thinking, reading the report, that on the one hand they make a top-down view from the macro side where they say, hey, productivity growth before the global financial crisis was 2%, and we think it's going to go back halfway between what we've seen recently and what we've seen pre-financial crisis. So that's kind of a top-down judgment. But then, and that's what gives what they had last time, 1.67, but then they're adding in housing reform. So that's kind of more a micro, bottom-up approach. So it feels like there's a little bit potentially of double counting that's there. And so I think, our forecast at Vanguard for trend growth rate is 1.5%. That's in line with estimates that the IMF have, and also in line with consensus estimates of where trend growth is. And obviously that's going to be a key factor driving the outlook for the public finances.
We'll have to get you back in when we get the next one to see who's right.
Thank you very much, Ms McAvoy. John Glenn MP.
Yes, could we turn to tariffs, please? And Dr. Salehin, could you explain to us how Vanguard's economic models incorporate the effect of the US tariffs on the economy?
Yeah, so if the question is about how our models take that into account, we would look at a range of different models, and we would estimate the impact of how, if the tariff rate went up on particular economies, what that would be for growth and inflation, right? So that's kind of the normal models would look at tariffs, and then you would shock those tariffs up, and then you would see how that transmits through the economy. Now, what you find is that actually that transmission, very simply, if you put up tariffs, what does that do? That puts up the price of the goods that the UK is exporting to the US, and so you would have less exports from the US, and through the trade channel you would impact GDP. But actually what we find is that that direct effect through net trade is actually quite small, and the bigger effect comes through the confidence and uncertainty, and those are the channels which drive it. So really, if you think of the modeling, it is actually quite uncertain, the range that you would get, and it would be very state dependent. So what is happening in your economy at the time? Is confidence level already low, or is it high? If it's already low, then obviously with that greater uncertainty, you could take a bigger knock than you would if confidence was high.
Because I think in the OBR's central forecast, they didn't take account of the effect of the US tariffs. How do you see that? We're obviously trying to scrutinise them as thoughtfully as we can, but it obviously does feel like there was more that could have been done. Given how central the US is as a trading partner to the UK, would it not have been more prudent to, at least with all the caveats you've mentioned, for the OBR to have put more on the US tariffs and the possible effect in their core forecast?
I think when we were thinking about our forecast for 2025, what we would say is obviously there's a whole range of possibilities on what tariffs would be, but we have to take a base case view on, the most probable outcome, what do we think will be on tariffs. And I think on that we did take a view at Vanguard that there would be additional tariffs on China, there would be additional tariffs on the rest of the world, and for the rest of the world we said there would be about a 5% rise in tariffs for the rest of the world. That was our base case view that we put into our forecast for 2025 and beyond, but we recognize that there are risks around that, and it could potentially be more than that. So yeah, you would want to have like a base case view despite the fact that there is, of course, a lot of uncertainty.
So the OBR could have done that if they'd wanted to.
Well, they could have done that. You'd have to take a base case view, and you'd have to take a judgment, right? So you'd have to have some judgment on what you think is more likely, what are the drivers, who would be effective.
Yeah.
So it probably does require you to look a little bit more in detail on what that would be, or look back to previous experiences.
I mean, I would imagine if the OBR were here, they'd say, well, we do things based on what the considered policy of the government is, and there was a degree of uncertainty over exactly how it was going to play out. But I guess that's always the case, and at the end of the day, the effects of the tariffs, as stated, were going to have an impact on the economy regardless of the mitigation. Is that a reasonable assumption for us to make?
I mean, I think, look, everybody has their forecasting practices, right? Some people do it when the policy is announced. Other people will say, actually, I want to make sure my forecast is as correct as possible, so I'm going to take a base case view. But it is a judgment, it is a view, and there will be a lot of uncertainty around that view.
Can I just ask, you did a base case, did you do other scenarios? Did you model other scenarios? Because 5%, well, from what we're hearing, could be quite low, and different levels will obviously have hugely different impacts globally.
Yeah, so we've done some analysis, sort of saying, well, what if it went up another 5%? Yeah. I mean, that now, given the latest developments, our base case view is that actually it probably will go up another 5% to 10 percentage points. So that's one view. When we do our modelling, we find slightly smaller effects than what the OBR has in their scenario. I think it's page 46 or something in the OBR report, where they have an upside and a downside scenario. And I think their extreme scenario, which is 20% on the rest of the world and everybody retaliates, you get an impact of minus or almost 1%. 23, sorry.
43.
43. Very good, though.
very, very close.
It's all a shame.
So I think our estimates are a little bit smaller than those estimates. So even, if we ran our numbers, they would be probably a little bit smaller than that. But I guess it depends on the assumptions. So we don't think that there potentially would be the whole rest of the world retaliation. I think some economies have been very clear that they will retaliate and that they will, take a stand, whereas other economies, it may not be in their best interest to retaliate, because at the end of the day, if you do put up tariffs in retaliation, you're going to see higher inflation in your economy, so it will hurt your economy, and do you want to do that?
Do you do comparisons with other people in your position doing these sort of forecasts? Or
Yeah, we would be looking at other forecasts and what is the modelling effect, and what are the assumptions that go into it. So
are yours similar to your cohort?
Ours are pretty similar to market estimates of the impact of tariffs, yes.
So Glenn.
Could I turn to Mr. Johnson? Thank you. Could I turn to Mr. Johnson about these forecasts? Because the OBR's World Economy forecast incorporates the data from the IMF's January forecast, which doesn't take account again of the recent developments in the US. One of the sort of central problems that is emerging, and I think all governments face this, is that when there is sort of grave uncertainty and there are challenges, the OBR comes into focus for being sort of a prophet of doom and also being over optimistic. But at the same time, shouldn't we be able to reasonably have some of these global factors more credibly incorporated into the OBR's forecasting? It has massive implications consequentially in terms of tax and spending and the fundamental choices that the Chancellor has to make. Is it not worrying that we can't have a more sophisticated model from the OBR on these admittedly a range of outcomes?
It's an incredibly tough judgment for the OBR, and I think they're in a very, very difficult position, and that because of the incredible sensitivity of the fiscal numbers, given the very, as I'm sure we'll come on to, the
my colleagues come on to
minuscule level of headroom that's left. Had the headroom been bigger, then it would have mattered less what the OBR said as its central forecast. And so I actually have a lot of sympathy with them, because had they decided, for example, it would not have been unreasonable to have downgraded their productivity forecast, to bring their growth forecast back in line with the sort of the consensus, to have incorporated some effects of tariffs. and then I don't know what the number would have been, but then the Chancellor would have been looking to make up 20 or 30 billion pounds in headroom, and that would have been an enormous kind of political sort of impact from their decisions. And I'm sure that subconsciously, at least, that must play on their minds. But in terms, and that's not their fault. I mean, that's I think that is the world we're in, with that sliver of headroom against the fiscal targets, where changes to forecasts are politically and economically so powerful. In terms of the decisions they've made, I suppose the difficulty is that and clearly, I mean, they can present other forecasts because they've given scenarios and they've shown what they think the impact of different levels of tariffs would be. And I suppose the difficult question is, was a forecast assuming no tariffs genuinely a central forecast? And it feels to me like that's a sort of best case scenario in terms of where you might think tariffs might end up. Now, you might think the tariffs around the world with everyone retaliating is a worst case, and that there's something in between. But my sense is that they've chosen something that's closer to a best case scenario, partly I think to be consistent with the IMF, partly I think because this is not actual policy. But whilst they're constrained to follow stated UK government policy, they're clearly not constrained to follow exactly the day of where policy is in the US.
This whole debate rather underscores that there's a very high degree of volatility in these assessments, and you've been through more fiscal events than we have over the last 15 years. But the variance between consecutive fiscal events is usually quite significant from something that's presented by successive chancellors as an authoritative view. Do you not, when you reflect on this particular element around international trade, do you think there's anything that could be done better to enhance the sort of authority of the OBR's judgments? Because it feels almost like there's a conversation with the Treasury to sort of work out what a sort of set of balancing scenarios is to sort of make it work, when in fact, as you've just said, around the potential 20 billion headroom that you could, on one very reasonable scenario, put together as being necessary to, that's not far from being a set of assumptions that a lot of people would have a consensus on.
I mean, I can't comment on how or if the OBR and Treasury work together like that. I mean, they're certainly not supposed to. So I hope that that's not what. I hope that's not what happens. I mean, really slightly to repeat myself. I mean, actually, the OBR's sort of the OBR's forecast between last March and last October pre-measures changed remarkably little, and they've changed quite little between October and now. So these are not big adjustments that they've been making. And so, why the Chancellor didn't change policy because the world had changed. Actually, the world, in terms of OBR forecasts, changed remarkably little over this period. But if at some point we do end up with the OBR coming more into line with consensus and taking account of the tariffs and so on, then I suppose I fear that there comes a moment where the forecast gets significantly worse. But I can just read. It's an incredibly tough judgment for them to make, and it is. And on that judgment hangs, it seems to me, too much. But it hangs too much because of the way that the Chancellor has not so much constructed the rules, but left herself with no space for manoeuvre against them.
Okay. I'll just ask one final question of Dr. Salehin on tariffs and any reflections you've had on recent events and what you see unfolding in reality with tariffs. What effect you think it's will have on the UK economy that hasn't been reflected so far in the events of last week?
I mean, I think there's two scenarios that you have to think about. On the one hand, if there is just an increase in tariffs for the UK, that could actually have quite a small impact on the marginal impact of that on the level of GDP, and inflation is actually quite small, 0.1, 0.2, that's what we're talking about. So it's not, it's within the margins of statistical significance. I think the situation which is kind of much more worrying is if it would expand into more of a trade war, and then everybody's doing tit-for-tat strategies, and then that could escalate, and that could lead to, you know, a downturn, you know, could lead to a recession in major economies, could lead to a global recession. That's kind of more of an extreme scenario. But the base case is actually that it won't be there because everyone's aware of that and they don't really want it.
Thank you. I think I've used up my time.
No, well, thank you. No, we could talk about tariffs. I think we will be talking about tariffs forever, won't we, at this rate? Yuan Yang, MP.
I have a question about the institutional framework that the OBR and the Treasury operate within. And there have been numerous proposals in the media over the last few weeks about doing things like changing the number of fiscal outlooks a year, of OBR outlooks a year, or adding other organisations that would make forecasts, for example, that the Treasury would continue to make forecasts as it used to do. And so on. I was wondering if any member of the panel have any particular views on those proposals or the institutional framework right now. Who wants to go first? Dr. Salahin?
Yeah, I was just going to say that obviously in some sense it makes sense, but then the question is the credibility of those commitments, right? So if you can't stick to those commitments, you might say, okay, I'm going to do one fiscal event, but then if you change it, I think that creates more uncertainty, right? So it's much better to have, you know, if necessary, 2 events or whatever events it is, but that just stick to that, and then everybody knows, like markets know to expect that. So for example, there was some uncertainty this time round. Would it be you know, a spring statement? Would there be news, or would it actually be nothing really? So I think markets then were like, oh, is there event, is there not event? So it does actually create some expectations in markets on what will happen, what will not happen. So you kind of get that uncertainty, which can be negative.
Yeah.
I mean, on the institutions, I think one of the things that is has been so striking in recent years has been the divergence between OBR and Bank of England forecasts. I think it'd be very useful if I mean, the OBR I think is, you know, very good at comparing its forecasts with outcomes. I think it'd do an enormous amount for transparency if we could have a joint report from the OBR and the Bank of England on, you know, why they are so divergent in their forecasts, in the way that, as I said, particularly the OBR I think has been transparent about some of those things. I don't think it'd be terribly helpful to have a Treasury forecast, because I mean, it's I'm not sure anyone would believe without wanting to be too rude, but yeah, there's a reason we got the OBR doing it, not the Treasury. Sorry, Ruth. On the frequency of events, it's interesting, isn't it? I mean, I've always been a sort of believer that one fiscal event a year makes more sense. But you are in this difficult.
Less work for your colleagues.
If you, sorry,
it's less work for your colleagues.
Not just for that reason. But if you've got 2 forecasts and 1 event, and again, if you're so close to those fiscal rules, that becomes very difficult. And I think one of the things that concerns me about where we are now, so we've had the forecast, the headroom has been maintained, but as we've been discussing, lots of potential downsides to that. I think there's going to be a lot of speculation now about what's going to happen in October, because we've had the forecast, things are looking on a knife edge, changed a small number of things. If things, as already is happening with tariffs and so on, begin to look a little worse, I really thought that the speculation about tax rises before the last budget was actually very damaging economically as well as arguably politically. I fear we will get that again, and that, I guess, the longer that you leave between events when there's a lot going on, the more you risk that.
Thank you. Ms. Curtis?
I mean, Paul's covered lots there. I would just add on kind of number of forecasts a year. I think it is important to remember that these forecasts are there for the Chancellor to set tax and spending policy. They're not only there for that. They are also there, for example, to inform the Debt Management Office of how many gilts to issue in the following year. And so they serve a number of really important purposes. And sometimes in this cost, and I think it's unlikely that the institutional solution is to sort of have less information. Unfortunately, the world seems to be changing faster than once a year. And so we might just need to deal with that.
I think every Chancellor says they only want 1 and then they end up having 2, but maybe I'm just a cynic. Okay, sorry, to Bobby Dean.
Yeah. We've been talking around it a little bit of fiscal headroom, but just kind of want to get into fiscal headroom in a bit more detail if we can. And perhaps to start with you, Mr. Johnson, because I know you've said some stuff about it already. I want to focus on this amazing coincidence that we've arrived back at the 9.9 billion figure.
9.93.
Yeah, exactly. Spoke to OBR this morning. They indicated it could be a coincidence, but it doesn't seem to me like it is. It does seem like this is a figure that was being targeted. Is that your view as well? And what do you think this does to sort of the fiscal policy decision making process?
I mean, it's hats off to whoever's in charge of the spreadsheet. To get within, I think it's within 2 million of a 9.9 billion number in a £3 trillion economy is quite something. I don't know whether that's precisely what was targeted. But my guess would be that the Treasury decided that they didn't want the number to go down, and that therefore that is a guess, though I'm speculating, which wouldn't be allowed in a court. It worries me a little bit, so possibly more than a little bit. I mean, two things I've written about. One is, and again, this is speculation, but it is very, very striking that almost all of the additional defence spending is capital spending, so it doesn't count against the current budget balance. And so, the truth about the overseas aid cut is that has gone to fund other departments. It hasn't gone to fund defence in any real sense. And I don't know whether it's right that a third of the defence budget is capital, but more than 90% of the additional defence budget is capital. I don't know, but I think the question sits there as a result of that. And we had announcements of welfare changes, cuts. A week before the fiscal statement, which I thought there were good reasons for those changes, but I worry the government undermines itself a bit by then coming back for just a teeny bit more to make those numbers add up. So I think that then the last thing I say is that the numbers added up also because if you look at the timing of the departmental spending increases, which we're going to get in the spending review, the numbers out because you've got a 1% in the final year, which is actually outside the spending review. And if we get a 1%, if we get this pattern of whatever it is, 2.5% next year, then 1.8, then 1.11. I mean, I'll take a large bet with someone that's not what's going to happen. I think there's a little, and this is exactly the criticism we made of previous governments, that they make the numbers add up by having a sort of fictitious couple of very low spending numbers at the end of the forecast period.
Yeah, and I guess as you're saying, it kind of feels like the achieving the number is driving the policy rather than the other way around. Because if it was just scored normally and it was, say, I don't know, £500 million out from here. Would that have made much difference? I mean, Dr. Sahin, I don't know how the markets responded if it was actually 8.5 billion worth of headroom, because that's just the way it ended up turning out versus not. Is it really important that they match this figure for the markets?
I mean, I think it's really important, the fiscal rules that are stated and whether the fiscal rules are being met, that's really important for markets. So they would be looking at that number, and that number is one of the fiscal rules, and is it being met? If it was 8.5 versus 9. No, they probably wouldn't have died in a ditch on that number in particular. But I want to say that markets focus on a few things. So the fiscal rules, is that important? Yes, absolutely. They will be focused on that. They also will look at the gilt issuance and what's that going to be. So, just under 300 billion was the gilt issuance for the next financial year. It's a lot higher than what we've seen in past years, and it's going to remain at that elevated level. So I think if that number was 305, 310, and the headroom was down, that would have also concerned markets. So they look at gilt issuance, and they will also look at how much of the gilt issuance is at the short, medium, and long end of the curve. That's really important as well, because if it's all in the long end, you're like kicking the can down the road and you're not dealing with it. So even on the issuance side, we learned that was lower than expected, coming in under 14% instead of what markets had expected, around 17%. So markets are looking at a few things. So growth rate, trend growth rate, gilt issuance, the split of that issuance across the curve, and whether the fiscal rules are being met. So a number of dimensions.
So a bit of variance probably wouldn't have been judged that poorly. But is the danger now that the government have chosen to match this figure, that this does become a new anchoring figure? Because rather than having the actual headroom, the new headroom you have to meet is within 9 billion. Do you think that the markets may pay more attention to that in the next fiscal event and say, well, actually, if it diverts from that now, because clearly that's the figure that the government are aiming towards, that would be a bad thing if they diverge from that figure?
I don't think that they'll be looking at 9.9 as being the critical value and focusing just on that. It's a composition of things, the broad-based assessment of things. But I think I did want to also comment that, on the one hand, if you say, okay, very focused on that billion of number, it is actually quite important that markets are satisfied that the government is abiding by its fiscal rules. I think that is really important because that actually drives some of the price that you pay for UK gilts at the moment, which is higher relative to German Bund, say by about 100 basis points relative to the pre-global financial crisis, right? So that makes UK debt more expensive, and it makes servicing that debt more expensive. So it is actually important to demonstrate to markets that the fiscal policy is credible, the rules are being met, the things are in the guideline, because hopefully if that fiscal credibility does come back, we could see some of that gilt yield elevation come down, which would be beneficial, right? But it's quite complicated because the differential in gilt yields between the UK and Germany is going to be driven by a whole range of factors, and inflation is actually an important factor. So the stickiness of UK inflation and UK wages that has been stickier than other economies is also a driving force behind that 10-year gilt yield being elevated. So I kind of want to give a little bit of perspective, like what drives that? What drives the price of that debt? It's a number of factors, but inflation and fiscal credibility, which is kind of captured in the premia, if you like, which is how much more do I want to pay for UK, to hold UK gilts.
You say fiscal credibility. Are you saying really certainty? Would it, if the fiscal rules were tipped a slightly different way, is it sticking to the fiscal rules or these particular fiscal rules in particular?
Sticking to the announced fiscal rules
yeah.
is important. So if you talked about, is that 9.9 billion a critical number? No, but if there was no headroom, would markets have reacted? Probably, right? Suppose they just said, oh, we're actually not going to do anything. We missed our fiscal rules. There probably would have been an edging up in the gilt yield reflecting, oh, they're not sticking to their rules. I mean, I'm talking theoretically, those are the channels of transmission.
Yeah, I mean, maybe Ms. Curtis might want to come in, but I guess part of the thing that I'm driving at is striving towards this specific number. The extra 500 million, for example, that's going into the welfare reforms as a result. So it's going to have a real world impact on thousands of people. And it seems to be because we're chasing this number that's written down, as opposed to sort of generally making policy reforms that we think are going to be productive for the economy as a whole. So I don't know if you want to comment on how this fiscal headroom figure is driving policy making as opposed to the other way around.
Yeah, and I mean, I think given that Paul and me and my predecessor will often say, 9.9 billion is not a very big number in this context. 500 million must be a very, very small number in this context. And there is quite I don't have the page number, I'm afraid, but there is an interesting chart towards the back of the OBR document which shows not just headrooms in the past, but this kind of probability of meeting the rule, which is at 54% at the moment. And I think what that chart demonstrates is that to change those probabilities, you also have to change your headroom by a lot, and therefore a kind of 500 million variance doesn't really affect the probability in the real world that the current budget will or won't be met in 5 years' time, given the kind of level of uncertainty in these numbers. And as you say, I think if the government had decided 2 weeks ago that there was a level of, for example, the health element of universal credit that was the right level for the next 5 years, having thought about the employment effects that they wanted to induce, it is surprising that changed 2 weeks later.
Thank you very much. John Grady, MP.
Yeah, I just want to come back to the confidence in sticking to fiscal rules. There's an interesting comment by Richard Hughes of the OBR last week, which is as follows: this spring statement breaks a historical pattern of asymmetric policy responses to forecast changes in which windfalls were generally spent but shortfalls were not fully made up. Dr. Salahin, how important is it for confidence of the UK economy that the Chancellor sticks to these fiscal rules for investors?
I mean, I think it's really important. You know, that's what people will be looking at. Your fiscal rules are there to be met, right? So seeing, especially, 5 years out, that fiscal rule, that broader measure, public sector net financial liabilities is falling. That is something that markets are very focused on. Are you meeting your fiscal rules? So it is actually quite important. And as you say, the current, windfalls are being spent, and the shortfalls are being dealt with later on. Obviously, that gives fiscal policy quite a big room to adjust and to absorb. So to that extent, the fiscal rules should allow you could still meet your fiscal rules with your policy, if that makes sense. So 5 years out, you're looking at that falling, that should be manageable. And if you're not meeting that, then markets would see that and worry about it.
And I think you explained earlier that the outcome of that would be higher borrowing costs of the UK government.
Yeah, if you miss your fiscal rules, yes, it would edge up.
And it would also mean, would it not, potentially higher mortgage rates for people in my seat? So constituents in my seat would face higher mortgage rates.
Yeah, I think if you're asking, like, if the government doesn't meet its fiscal rule, will that drive up the 10-year gilt yield? Probably. How much? Is that 0.05, 0.1, 0.2? Remains to be seen. Would the rise in the long-term interest rate affect mortgage rates, affect other financial conditions in the UK economy? Yes.
And I think it's quite important to put this in the real world of my constituents, you see, Dr. Salahin. So their mortgage rates would go up if the Chancellor was reckless with the public finances. Just thinking about housing, because we're very keen on getting more houses, I think everyone is. The housing developers have to borrow money to build the houses before they sell them. And presumably their cost of debt could go up as well, because lenders reference to the risk-free rate, don't they, when calculating what they're going to lend at? It's one of the things they take into account.
I think it depends, right? So on the particular question on mortgage rates, right, it will depend on the type of mortgage that the individual has, right? So it doesn't mean that there's a market response and suppose the gilt yield went up. It's been very volatile, as you can see from the chart in the OBR. If you look at the evolution, it does go up, it does go down. There's been quite a lot of volatility recently, partly UK-specific, partly global factors. So these rates do go up and down. They don't always necessarily translate into your mortgage rate straight away, right? Because mortgage rates are kind of more slow-moving. But the principle in general that, yes, if they went up and they were sustained at a higher rate, so it was more permanent, then yes, it would go through and feed through to borrowing rates.
So the gilt rates going up on a sustained basis would affect the cost of capital for businesses in the UK, which would affect business investment and potentially affect jobs as well.
So it depends really. So I just want to be clear that the 10-year rate is quite different from the risk, the Bank of England rate. And a lot of these borrowing rates that companies or households will have, some of them, it depends. If it's a fixed rate mortgage, you're going to fix on the long rate. If it's kind of a more tracker mortgage, you're going to fix on the short rate. So really there are some nuances in there onto, which interest rate is going to move and the impact that will have on those borrowing rates. But in principle, yes, if interest rates go up, then borrowing does become more expensive.
That's why it's important to make sure the public finances are run well. And if government borrowing rates went up and interest rates went up across the economy, and there's a relationship between the two, that presumably would be damaging for economic growth.
Yes. Yeah. In general, that's the transmission mechanism of higher interest rates, is that it becomes harder to borrow. It becomes more expensive. So consumers, if they have any form of debt, whether that's overdraft or whether that's their mortgage or any kind of borrowing, new businesses, new borrowing, in general, it will go up. Yes, it will be negative for the real economy.
So if you're out with me with some voters in Mount Vernon in Glasgow East, lovely part of the sea, it's all brilliant, you would say to them, I suspect, that it's very important that the Chancellor sticks to her fiscal rules and runs the public finances responsibly, because if she doesn't, it could have real world implications for them in terms of their own family finances.
Yeah.
Yeah. And then coming just to headroom briefly, and then I'll finish up. Chart 7.2, I think it is, of the OBR report, which I will find myself.
Page 144.
Thank you very much. Got a post-it in it. It shows an average of headroom up to March 22 of around 30 billion, and then it drops down from November, so through Jeremy Hunt's tenure as Chancellor of the Exchequer, and then onwards, October and March, to around this roughly 9 to 10 billion mark. I think
one chance I just would note is missing from this, but they were there so briefly that.
Well, I know we better not get into that. We'll come back to that later, Dame Meg.
That might be the reason for the drop.
And I think we know who it is. But anyway, I think he's back in the press giving advice again, actually. But anyway, good for him.
We've got three great people in front of us.
Mr. Johnson, is the current headroom enough in your view?
Well, enough for what? I don't think it's enough for confidence that we won't need more adjustments over the next fiscal events. I mean, the problem is, as we've been discussing, given the rules are there and given the way the markets look at them, it is going to be important for the Chancellor to meet those rules. And it's worth just stepping back a moment to say why. Because we can see that borrowing is not free. I mean, one of the big problems facing this government is that we're spending well over 100 billion a year on debt interest as it is. And if you take that further, that creates more problems down the road. And even on the debt rule, if we were to look at the measure inherited from the last government, the standard measure of debt, that's actually going up all the way through the forecast period. So, this is not a tight fiscal policy. I think it's very important to be clear. This is not a tight fiscal policy. This is a fiscal policy which is just about meeting some relatively loose fiscal rules. And leaving yourself, but coming to your question, leaving yourself 10 billion of headroom against that, there's a very significant probability that you lose that as you move through fiscal events. That creates uncertainty as you go towards those and forces the government's hand to either cut spending or increase taxes, at least into the future, in terms of what's promised. So we will be in a better world if we had more like the average pre-2022 or whatever it was level of something like 30 billion of fiscal room, because then you've got much more space for manoeuvre. It is worth saying that I think from this time next year, when we're only 3 years away from the end date of these rules, the government has said it's allowing itself 0.5% of GDP of wiggle room against them, and that helps with, particularly if you've got a couple of forecasts a year, but only one significant fiscal event. But it's a very long way of saying, it's all things equal, it'd be better to have more headroom. But of course, if you create more headroom, that means you're either promising higher taxes or lower spending. And neither of those are particularly desirable in their own right.
And maybe a final question for Ms. Curtis. If we decided to go hell for leather and increase this headroom as quickly as possible, kind of, Geoffrey Howe style 1981, that implies quite significant tax rises or spending cuts. What do you think the implications of that would be for my constituents in Glasgow East?
Well, I think it would depend. I'm sorry to give a equivocal answer, but I think it would depend very much on how those changes are done. I think just on the structural break in that chart, and then I'll come back to your question. What really happened between those two lines is very significant rise in the interest rate, as Paul says, and a kind of structurally much harder fiscal position. And so both governments, subject to that second lower line, have been grappling with the trade-offs between headroom and balancing the public finances when it's kind of got structurally quite significantly worse off, even though the rules have changed through that period. And then the choice that the Chancellor faces, as you imply, is sort of how quickly to tackle that problem, and more headroom now would require her either to have set lower spending targets all have higher taxes. I think it's worth saying in this event there weren't, in the grand scheme of things, very big adjustments to public spending. And so she seems to have broadly decided, subject to some important detail that Paul's the expert on, between ODA and Defence, that the numbers she set in the autumn, which were quite a big increase in public services, were the right ones. So clearly, if those have been lower, then public services would presumably be less good for your constituencies than they otherwise would be. But we don't really see in the spending review, we don't really know what those quite significant increases in the autumn will mean. On taxes at the Resolution Foundation, we do see scope to increase taxes in a way that would not significantly harm growth, certainly in the short term. She did have the option, for example, to extend the threshold freezes. That would cost your constituents in the last 2 years of the forecast, but wouldn't have cost them in the short term, and would obviously hurt wealthier households more.
Would you approach this in a gradual way or a quicker way? What would your advice be if you're advising the Chancellor and her team?
I think that's a really great question. I think there are quite big advantages to tackling as much upfront as you can. It reduces the uncertainty that Paul has talked about, and I assume, although you're the experts, that it's politically easier to make some of those choices earlier in a parliament. But it does mean raising taxes in reality in a way that impacts the economy, and so you obviously don't want to go too far in those judgments. And given she made quite big moves in both tax and spending in the autumn, I think it is a difficult judgment whether she could have gone even further to shore up the fiscal position or not.
Thank you. Thank you very much, Mr. Grady. Dr. Jeevan-Sandra.
I was just shocked by Dr. Salihin said about fiscal rules and the impact on interest rate and gilt. So the last government had 7 sets of fiscal rules, and presumably they changed them 6 times because they were going to break them 6 times. Am I right in thinking that would be, you would see an increase in the interest rate and the gilts 6 times given the testimony you just had?
Yeah, I mean, I think that's one of the reasons why we have seen, trending up of the gilt yield above the German Bund, right, which is a measure of the risk premium, because there's been quite a lot of chop and change, and this uncertainty has kind of been factored into how fiscal risk is being priced. So yeah, chop and change is not necessarily good, and it is priced into markets. If you look at the rates now, we're trading about 200 basis points above German Bunds, whereas if you looked back, before the global financial crisis, it was more like 100. So we are seeing that priced in, the chop and change that we talked about.
I'm thinking what I suppose Germany also quite a tight debt break would have led to less spending overall, but I will leave that there, Chair, and I'll come back to you.
Thank you. Mr. Chris Coughlin, MP.
Just go on. Mr. Johnson just struck me in something you were saying. We're obviously fiscally pretty loose, like you said. We're running pretty hot in terms of our borrowing capabilities. So isn't it slightly extraordinary that we're borrowing money, injecting it into the economy, and yet growth is going down or flat? It doesn't sound very Keynesian to me.
I'm not sure that most of the policies aimed at being Keynesian, particularly given that, as you say, the economy is not. I think the OBR now thinks we might be slightly beneath trend, but I don't think the effort is a Keynesian one, and indeed, as I think you discussed this morning, there might have been a risk with the big increase in investment spending that there have been a little bit of crowding out there. But the big picture of going back to the last question, the big picture of the last 25 years has been that we've moved from low borrowing, low debt by OECD standards to high borrowing, high debt, and from sort of well below the G7 to about average for the G7, which reflects a continual sort of period of relative fiscal looseness, which has been related to very poor economic performance.
Thank you very much, Mr. Coughlin. Bobby Dean, MP.
Thank you. I want to move on to the welfare reforms in a bit more detail. I might start with you, Ms. Coates, if we can. I think there's kind of widespread acknowledgement that the welfare reforms could result in better outcomes for people if more people that are currently out of work or disabled and struggling to find work get into work. That would be a good thing for both those people and the economy. But given our past conversation about this driving towards a figure for fiscal headroom, it seems like these reforms may not be driven by that. We've also not yet received the findings of the Sir Charlie Mayfield report, which is meant to give us more insight into how we can do this best. So do you fear that this moment has been about balancing the books on the back of the poorest and disabled?
I mean, I think the welfare changes are about balancing the books, and I think it's worth separating them into two buckets. One is the changes to disability benefit, or PIP, which is a benefit paid to people regardless of whether they're in work, and I'll come back to that. The other bucket is the changes to universal credit, where I think there are changes that seem to be based at kind of achieving higher employment. And the reason I think it's important to separate those two is because the government clearly had two objectives in looking at this. It wanted to save money on a bill that has been rising, and rising quite sharply when we're talking about working age, health and incapacity benefits as a overall, and it also wanted to improve the incentives in the system for employment. And those are both reasonable objectives, but some measures, some of the policies achieve some and some achieve the other. And I think in particular the changes to PIP, to disability benefit, which raise 4.5 billion of the 4.8 that net the Chancellor is raising through welfare changes, are a decision to change the level of disability which as a country we will compensate people for the costs of. Those are paid regardless of whether people's in work, and because you're changing eligibility, it means that the savings come from cuts to a very large cuts to a relatively small group of people. So you're raising 4.5 billion by removing eligibility from 800,000 people and also from carers allowance for 150,000 people. That means, as DWP told us when they published the impact assessment, those people losing PIP eligibility lose £4,500 a year on average. We estimate that's an 18% drop in income for those people, for people who are quite distant from the labour market, who have not faced a disincentive through the benefit system to work as currently. I think the evidence when it comes to disability benefits is that given they're paid regardless of whether you're in work, on the one hand, a big change in income in general does affect people's propensity to work. Having a slightly higher income makes it slightly less worth your while working, and there are recent studies in the US that find effects there. On the other hand, those are done on the kind of general low-income population, not on people facing particular barriers to work. And there's evidence on the other side that these payments are enabling people to do things like have a car or get taxis to enable them to work. So to us, on the disability benefits, there's effects both ways, and they look like reforms that are designed to save money, not reforms that are designed to increase employment. I'm happy to come on to universal credit, but conscious I've already given you a very long answer.
No, that's answered my point well, because obviously the government are saying that the driving purposes of reforms is to get people back into the work, but it sounds like from what you're saying that you don't think there'll be a huge proportion of those that look like they may lose out, particularly in relation to PIP payments, that will be able to get into work or will be newly incentivised to get into work. So for you, this is much more about driving down costs than it is about getting people back into work.
Absolutely. The changes to disability benefits, which make up the bulk of the saving, don't seem to be about getting people into work. I should add that the changes to universal credit do rebalance incentives in the system in a way that I would expect to have some positive employment effect. I think when you started the question, you said kind of overall it would be better for people. I think it is really important to say that even if you make pretty optimistic assumptions about how much extra employment might be generated by these changes, it's never the expectation that that everyone will work enough to make up all of the income they've lost. So there's no plausible employment effect, which doesn't mean that net what's happening is millions of people losing quite significant sums of money.
On that point, I don't know, Mr. Johnson, if you might want to come in. OBR wouldn't be drawn on this morning the potential impacts on employment because they didn't have enough detail to date. But would you be able to estimate any sort of ballpark region, or what you think? Is this going to be, what kind of proportions would you be talking about people might be able to return, what effect it might have on the overall state of the public finances?
I don't know the answer to that, but the answer will be, tens of thousands, not or possibly 100,000. It's not going to be many 100,000. I think it'll be. I think it'd be fair to say, it would take some serious modelling to actually give a better answer than that. But as Ruth was saying, the changes to universal credit will have some positive impact for those who are otherwise on the health-related element on personal independence payment. I think it's a policy decision driven by. Let's be clear, an absolutely astonishing increase in the numbers of people claiming this, and a decision that that's not what the government wants.
Thank you. Thank you very much, Lily McAvoy MP.
Thank you, Chair. Sorry, Ms Curtis, you just said that the changes to PIP will result in an 18% drop in the income of recipients. Can you elaborate on that? Because PIP isn't means tested and some people are in work, so I don't understand how you could say that a fixed amount of money would equate to 18%.
So to be really clear, what the government have told us is that there'll be an average annual loss of £4,500 for the 800,000 people who the OBR estimate will lose eligibility. What we do is assume that those losses are distributed equally across the current PIP population. Now, we don't have details from the government about actually who will be affected by condition or income or age, which I think is unfortunate, but therefore we make an assumption that they're distributed across current PIP claimants, and we assess £4,500 would represent to those people 18% drop in their income. If they also was an employment effect, which we don't take account of because the OBR or the government have not estimated one, then that would reduce that 18% figure. But as I say, I'm not expecting an employment effect from those changes.
For your organisation, obviously there's some significant missing data from this analysis that you've made, so why make it?
I don't think there's significant missing data. I think whenever you do distributional analysis, you have to make an assumption about who's affected. I think it's largely a government number, right? £4,500. I'm just trying to help people understand what that represents as a proportion of the income of people who are affected.
Right, and so when you saw the reforms that were outlined in the white paper and the green paper and then in the spring statement, was there anything missing that you would have liked to have seen as an organisation, anything that you were screaming at the telly you would have wished to see to help support people back into work, or just in general balance the books?
Yeah, absolutely. I think on the topic of welfare reform, I was really, really disappointed when the detail of the figures came out last week, that the employment support of £1 billion that had been promised comes in 29-30. It's only 400 million the year before, so it more than doubles in that convenient year where they don't have to actually allocate it. And given the problems that the government is clearly seized of, I'm really, really surprised that they haven't found money this year, let alone more money in 2026 when the cuts come in to provide for that employment support.
And what about changes to the broader welfare system? Were there any things that you would have liked to have seen reformed? Rather than changes to the government's decisions?
So to be clear, we do think there is an issue in the system around health and disability benefits. So, for example, the changes in universal credit have been done in a way which represent a cut, which is not the way that we would have done it. But we do think that the rebalancing between the standard rate and the health element is the right direction of travel. I would also not rule out in any way changes to eligibility for PIP, for example, because there have been really striking trends, as Paul says. But I would hope that those would be made in a way that is clear who's affected and that is really carefully thought through given the very significant impacts on individuals, as I say. At the same time as the government is making these changes, it's announced that it will do a review of PIP to ensure that it's fit for purpose. That sounds like a good thing to do, but it sounds like a good thing to do before you make very specific changes to eligibility that will hurt families.
Okay, so you agree with the changes to eligibility, you agree with the universal credit rebalancing. I
don't think I said I agree with the changes to eligibility. I agree that it's a good idea to look at the PIP system and how it's operating. The specific changes they've made to eligibility, as I say, will have very...
Yeah, we don't know yet. Okay. Okay, and so there was nothing else that you were... Because it says, I think, in your an extract from your analysis that you previously called for the same rebalancing as the DWP did in its green paper. And so was there anything else that you were pleased to see?
So I think the increase in the basic rate of universal credit, which undoes about half of the erosion in the value of that benefit that we've seen since 2010, is very welcome.
Okay, thank you. Now, Mr. Johnson, this is your last appearance to the committee, so I will give you free rein to tell us what you liked. What you liked about the spring statement and the changes to welfare. What would you support?
I mean, I think on the changes to welfare, action was clearly needed. I mean, it is really extraordinary what's been happening to spending on the health-related elements. I think, rather like Ruth, I'm rather disappointed that we didn't get the review, the analysis, the evidence before the decisions. And actually, again, we shouldn't be starting where we are. The DWP, frankly, over the last 2 years should have spent a very large amount of money on understanding the problem. And if they have, it's not evident in what's been published or indeed with discussions. I mean, this is part of a strange budgeting arrangement where there's a sort of free-for-all on benefit spending and very tight on the administration on the administration spending. But in a sense, it's good to see that being somewhat gripped. I mean, if we look over in terms of good over the last couple of events, I think it's good that the government is, unlike predecessor chancellors faced with big fiscal problems, protecting investment spending. I think it's good to see some reforms to the planning system. I think they could go further, and on the investment spending, I think they could be more growth focused. I think it's probably inevitable back in October that we'd have some increases in spending generally relative to what was planned before. But I suppose what worries me a little bit about what we've seen over the last two fiscal events is a lot of good intentions for the future, but less in the way of implementing them in the short run. So again, going back over old ground, choosing a very inefficient tax to raise most of the money back in October, promising fiscal prudence, but borrowing an awful lot more in the short run. Now, again, this government didn't want to inherit what it got, and I think some of that was probably inevitable given what was left behind.
And so just to bring it back to welfare, is there anything that you personally or as an organisation lead at the IFS have been calling for a long time that you would have liked to have seen reformed in the welfare changes that we're bringing in?
I think there are lots of problems in the welfare system. I mean, we continue to have a housing benefit system which is not, which was made a bit better. Was it a year or two ago, but still is not related to actual housing costs, creating all sorts of problems for all sorts of individuals. I mean, a lot of the issues here are also about sort of judgments about levels of generosity, and that's where we are with the 2-child limit, for example, or about the actual basic level of universal credit. But I think what the government has done is focus on what is the biggest problem in front of us from I think not just a fiscal point of view, but also from PIP was not designed to be, certainly was not designed in the expectation that it would be such a large-scale benefit. With by the end of the decade, 1 in 10 of the working age population being on some kind of health-related benefit, you can see why government wants to do something about that. But I very much agree with Ruth that it would have been good to have seen the analysis and then the outcome.
Thank you. Just final one. So can I just, for clarity, so what were you saying about the two-child benefit cap?
I'd say it's a choice. I'm not saying one way or the other.
Okay.
Thank you. Dame Siobhan McDonald.
Ms. Costa, I just want to understand about the PIP side of things, because obviously the thing about PIP is it doesn't matter whether, I say to my constituents all the time, it doesn't matter whether you're the poorest person in the country or the richest person in the country. It's not means tested, it's dependent on your circumstances. So I'm trying to understand this 18% of income idea. I completely understand basic rate PIP, it would be £4,500 a year. I get that. I don't get the thing about the 18% of income.
So we have data on current PIP recipients.
And you know what their overall income is?
Through survey data, yes. So not all PIP recipients, but modelled from survey data, as, for example, the Treasury's distributional analysis is. And we know, therefore, what their household income is. And in general, PIP is not means tested, but PIP recipients do tend to fall in the lower half of the income distribution. But 18% is simply £4,500 of on average, PIP recipients' income.
Because there's an awful lot of people I know who it wouldn't be anywhere near 18% of their income.
Absolutely. I'm afraid there's some other people for whom it's much more than that. So I think it's a quarter of PIP recipients. PIP represents over 40% of their income, for example, as a household.
Thank you, that's very helpful. Bobby Dean.
Yeah, I just thought it was important we address the point about the proportion of people due to fall in poverty according to the DWP analysis, because it's been subject to much conversation the last few days. So they say 250,000 in poverty, including 50,000 in children as a result of these measures. Government says no, because it doesn't take into account the people that are going to work. But we've just had a discussion about probably quite limited numbers of people being helped into work by these packages. So could you give us an assessment on those figures, how true you think they'll turn out to be, whether we'll be looking at close to 250,000 or another ballpark figure that you would imagine we might end up at?
Yeah, and on that, Bobby Jean, can you give us your analysis on double counting in that initial impact assessment, how the things will interact, and on the severity for lifelong people with lifelong conditions and how that will interact with that as well, please?
That is, sorry, stack of questions.
Wasn't planned.
Okay, I'll do my best.
Your brain's fizzing with it.
So I think one important thing to say about the impact assessment is it's a combination of all the things that are being scored in the forecast. So that means two things. First, it means that it includes the effect of not going ahead with the previous government plans to change the work capability assessment. So there's a previous cut not happening. That's completely fair enough to reflect. That is how it reflects in the scoring. But in terms of how it feels for people or how the impacts will be relative to the system today, it's a different question. It also means that they are not reflecting much of what was in the green paper, which is not being scored. So that includes the prospect of transitional protection or protection for people with severer conditions, which the money for which has not been scored and it's not in the impact assessment. It also doesn't include the removal of the work capability assessment entirely and using PIP as a route to universal credit, which could mean quite significant changes for people who are currently only eligible through the WCA. So there's big changes in the green paper that are not in the impact assessment. In terms of the impact assessment and employment, we haven't done separate poverty projections, so I can't give you a number. I think given what we've said about the employment effects being likely tens of thousands, at most 100,000, Paul said, it seems unlikely that would make a material difference to these poverty numbers that are rounded to the nearest 50,000.
If I could just read between the lines. The government's expectation is that figure will be dragged down by their employment initiatives, but you're saying there's actually risks it could go up because it doesn't take into account all of the changes that have been proposed.
Yes, I think there has to be a risk that the changes to WCA, for example, are at least as big as the employment effects. I think we don't know which direction it will go.
Thank you.
And this morning the OBR was also saying that with PIP there could be, it becomes the difference between being on PIP or not and not having health-related benefits under universal credit means there's quite a cliff edge potentially there. So they think that there could be some movement towards people being put on PIP who or even with the eligibility criteria tightening, on a judgment, they will be put on PIP rather than not on PIP.
Absolutely, and there's a lot of people who currently claim PIP who could, for example, would be eligible for universal credit but don't claim it. It might be that there are quite complicated interactions and effects. Yeah.
And then I just want to get on to sort of more the bigger interactions. We've talked about the headroom, this miraculous 9.9 billion figure that you say is quite clever to keep landing on. The spreadsheet gurus are doing their job, but we all know that annually managed expenditure is the bit that in the equation is the easy bit to squeeze in year. So this is the DWP budget largely, Ms. Curtis, isn't it? And do you think that there's a risk that we will see? We saw already extra cuts in the spring statement, and then we've got the challenge. There's discussions a lot about child poverty again. Some of that money coming from the DWP, depending exactly what the child poverty task force comes out with. Do you think that Amy is they're going to be the victim of any future changes with tariffs, all of the other rocky things that are going on globally, that we could see a real further squeeze? Or do you see any other alternative?
I mean, look, I think clearly if the headroom is gone again, the government will look at resource spending, Amy, and tax all together. I think the autumn will feel very different because the government will have finished its spending review, so it will only have this 1 year before the fiscal rules bite without spending totals allocated. So it is interesting, the decision not really to touch spending totals at this event, because it was sort of the last chance realistically to do that. So I think it will then become a choice between tax and welfare, Amy, as you say, in the autumn. We are disappointed at the Resolution Foundation that the government's decisions so far have a bigger impact, almost twice as much as a proportion of income, on the poorer half of households as opposed to the richer half. And so we would certainly hope that tax is the area she would go to next if she had to, given that would have an effect on the richer half of the population.
Well, talking of tax, Mr. Johnson, you've been quite trenchant in your views on this over 15 years, but also in the recent couple of weeks. What taxes are there now that could be pushed if it's not Amy spending? Where would the tax potentially come from? Because we're talking about quite small amounts on some of the taxes that are available, given the Chancellor's ruled out a number of tax rises.
It's not easy, and I mean, it's important to understand the baseline in terms of where we are, which is that what are the taxes that we all know taxes are now pretty much at their highest level that they've been, but they're not coming from people on average earnings or below average earnings. In fact, the average, the average tax rate they're paying, certainly in terms of direct taxes, is well below where it was 30 years ago. They're coming from a combination of very big increases in taxes on the highest earners, very big increases in corporation company taxes, increases in quite a lot of other smaller taxes, including property taxes. If you look internationally, if you look at the direct taxes and all other countries essentially which have higher tax burdens than us, essentially they've all got higher taxes on average earners. Now that's not a politically easy issue, because obviously there's a lot of pressure to get it from the rich or get it from companies or what have you. This month is the 50th anniversary of the last time the basic rate of income tax was raised by Dennis Healy in 1975.
Did well 4 years later.
A birthday only you would know, I think.
When it was raised from 33 to 35, and back then the top rate was 98. But I think that's not true of that's not true of VAT. It's not true of employer income national insurance, of employee national insurance, of almost any other major any other major tax. But I think that indicates something about the political pressure in terms of the way that the tax burden is distributed, and hence we got the tax rise that we got in the autumn.
So you're saying there's nowhere easy to
well, if I were Chancellor and didn't have to be re-elected, which I appreciate is not a realistic situation to be in, then I probably would be looking at things like the basic rate of income tax. But I don't think that's where history suggests.
No one's going to vote for Paul Johnson to be Chancellor for the day.
Well, quite. It's 50 years since the Chancellor has done that.
Can I just add a small one on capital gains tax, which is often seen as something that the government, well, some say didn't go far enough. It raised it to 24% if they didn't completely align it to income levels. There's been also some speculation over the behavioural effects leading up to that, as people are anticipating it in terms of the revenues. Have you got any observations about that as an option in terms of whether you could go further to raise this little bit extra and balance the books? What do you think? Because we've discussed the likelihood of a lot of speculation over the next 6 months, given the tight headroom. What do you think about that?
Two parts of that. I think the speculation around this is really problematic, and there was other.
Not ask the question tomorrow, then.
Sorry?
Ask the question to the Chancellor tomorrow.
Maybe it should be categorical.
I think that there was lots of speculation before the last budget, which was really damaging. Actually, one of them was around capital gains tax that created behaviour or change. The other was around pension taxation. Where that was we know that a large number of people cashed in their pension earlier than they otherwise would have done because they were worried that the tax system would change. As it happened, the tax system didn't change, but equally, what I think the Chancellor should do is rule out any further change in pension taxation for this Parliament, so that otherwise, I think we'll get the same impact again before the next budget. So I think that sort of, and because I have no idea what the tax strategy is, and nor does anyone else, no one's got any idea which way the Chancellor will jump at the next time that more money is needed. On capital gains tax specifically, I absolutely do not think we should simply raise the rate. But what we do need is a rebalancing of the base. So at the very least, you need to give allowance against inflation, and I would argue allowance against inflation plus a bit. If you do that, then there is scope, I think, to increase the rate to something closer to the marginal income tax rate. But if you don't change the base and just change the rate, then I think you do risk causing economic harm.
We probably won't tempt you into stamp duty just now, because I think...
We do.
You and Yang MP.
Thank you, Chair. I want to go back to the discussion with Ms McAvoy about the problem of increasing claimant counts and expenditure and disability and incapacity benefits, and just drill a bit more into what kind of a problem this is. I presume when Mr Johnson and Ms Curtis, you mentioned that this is a problem, from one perspective it's a fiscal problem. On the IFS chart, looking at spending on working age health-related benefits as a share of GDP over time, we've got incapacity benefits going down from above 1% of GDP in the early 2000s and then back up again post-pandemic to just around 1% of GDP. Disability benefits creeping up steadily over time with a bit more of a sharper uptick from below 0.5 to around 1% post-pandemic. So that's the kind of range. So I was wondering, when you say it's a problem, do you have the fiscal problem primarily in mind? And if so, does it even make sense to ask the question, what percentage points of GDP should we be spending on these benefits? Or is there a different problem that you have in mind? Presumably there are also problems with the fact of so many people being ill. So I was wondering if you could start on that, Mr Johnson.
I think there are three problems, aren't there? One is sheer amount of money. I mean, if you're looking at the OBR forecasts for all health-related benefits by the end of the decade, you're looking at £100 billion a year. Now, that is a very large amount of money. There's a second problem, which is that this seems to be at least somewhat indicative of a health problem, and that's clearly an issue in itself and does need to be dealt with alongside any changes to the benefit system. And a third problem is the combination of incentives within the benefit system. I mean, the chart also shows that other working age benefits haven't gone up at all over this time as a fraction of national income. I think it's partly because there's actually a very big incentive, if you can, to be on the work-related benefits, which then take you further away from the labour market and create problems of work incentive problems in themselves.
And I mean, Paul's covered the overall numbers, so perhaps just to add, I guess I think you're right to ask the question in terms of just a rise in caseloads would not be an indication of a problem in a population that is ageing, and it's not just ageing in the sense that there are more pensioners, it is also the working age population is ageing, and that will tend to mean that we have a higher rate of health-related inactivity for a given population. But when you dig into the caseloads, what we're saying is that the caseloads seem to rise by more than is explained by what you might expect from those effects. And I think of the problems Paul described, as we understand the data, there does seem to be this particular uptick in young people, and that is particularly concerning given they're at the start of their working life.
And so in response to that, does it make sense to have let's say, a kind of fiscal first solution where you decide what is a percentage of GDP that should be spent on these benefits and kind of work from there? Or how should the fiscal calculation feed into the broader policy calculation in your view? I'll start with Ms. Johnson.
Well, clearly there isn't a correct proportion of GDP to spend on these things. I mean, clearly you've got this, as I say, this remarkable change which occurred, somewhere around late 2021, early 2022, in the numbers of people coming forward and claiming each month, understanding exactly what's driven that, and the very, very low levels of numbers of people coming off the benefits as well, alongside this apparent uptick in mental health problems among younger people, alongside the sheer numbers of people affected, and a lot of the people affected are clearly, this is not the life they want to be living. So all of that should be driving change. The cost is clearly an important ingredient of that, but you clearly shouldn't be targeting, I don't think, a particular number, although you probably think that continuing to increase, well, I'm sure you do think that continuing to increase at this rate is not where we should be.
Yeah, I mean, look, I broadly agree with that. I don't think there's a right answer to the percentage of GDP, and we should expect particularly different bits of the benefit system to take the strain at different times. And the welfare bill as a whole was in the autumn constant as a share of GDP and now falls slightly. But it's really, as Paul says, what matters is what the changes in spending are telling you about underlying what's happening in the system.
Thank you. So Chris Curtis, MP.
Thank you, Chair. Dr. Saline, is...
Sorry, Chris
don't worry.
There's so many new MPs, and for momentarily, I mistook you as my Milton Keynes colleagues.
Dr. Saline, does investment in defence have a more significant positive impact on output and growth than other sectors? And of course, I'm thinking about the Chancellor's focus on using defence spending to boost economic growth and upgrade long-term GDP forecasts in the spring statement.
Yeah, I think on defence spending, what I find really interesting is obviously everybody wants to do this, right? Everybody wants, like we've seen in Germany, they're spending more on defence. They want to become, the leading person on military expense, because at the moment most of that comes from the US. So we see quite a lot of leakage, if you like. Even if you spend more on defence in the UK or in Europe, where does that money actually end up? It actually ends up with the US. So then it's not driving growth in the UK. What I will say about the increased defence spending, I mean, obviously that's good news in terms of like the security for Europe. However, what does that translate into in terms of the impact on GDP and long-term GDP? I think there's quite a lot of uncertainty actually on those fiscal multipliers. So fiscal multipliers is one of those things, it's very, very uncertain. What I found particularly interesting from some of the work that's been cited, I think you've been involved in some of that as well, is that the way that they're talking about defence spending, it's really R&D spend. So it is all about TFP at the end of the day. It is all about that elusive productivity growth. So yes, it is true that if you do spend more on defence, and if you do orient it towards R&D and innovation, then yes, that is going to lead to higher growth rates. But the devil's in the detail. Some of those numbers, the fiscal multipliers, 1.5 to 2, they actually seem quite high and quite big relative to other numbers that we've seen, stated. So I would say they're kind of on the top end of the spectrum relative to the literature.
Sure. And do you think that the spending on defence is sufficient to turn the UK into a defence industrial superpower, as the Chancellor would like?
I mean, I think obviously I can't answer that question, right? It's really hard to answer that. But I mean, one of the things I would say is obviously if that defence spending is going to go up from 2.3 to 2.5 and then up to 3%, then that's good news. You're spending more, and if that's directed in the right way. One thing that I would note is some of that's unfunded right now. So how are we going to go up 2.5 to 3? Where does that come from? And how will that either complement or substitute any growth effects that we'll see? But in general, it's going to be a challenge, right? It's good news that we try, and I think it's part of the initiative of trying to boost that long-term growth, which, capital spending going up, public investment going up. I think that's really good news, and we should keep trying to do that, because that is ultimately what is going to make the fiscal math much more in our favour. And we've already talked about, interest rates are higher, there's a lot of pressures. Growth is the only way out, so we should definitely try to do that. Whether we can become that superpower or not remains to be seen.
Great. And finally, Mr. Johnson, with the cuts in aid, how will the poorest economies be impacted by that, especially alongside what the US and other countries are doing as well?
I'm afraid I'm no expert on that, so I can't give you anything other than a sort of layman's view, which is that the UK aid for the specific countries affected will be a significant effect. The US aid cut much more so. My sense is that other countries may follow suit. This may well change very significantly the flows of income to poorer countries and poorer people, in a way which is, I was in the Treasury, I think, in the early 2000s when the Gleneagles Agreement was reached that we would get to 0.7% of national income. The sort of apparent consensus on that has melted away remarkably quickly without anything being put in its place about how we should think about our role in that world and how we should think about international coordination and the role of aid. And beyond that, I really can't say. But to the extent that this put all of the aid givers together, and that makes a significant difference to flows, that risks making, in the short run, quite a painful transition. In the long run, I think the jury remains out on the long run impact that change will have.
Thank you, Mr. Colton. Rachel Blake MP.
Thank you very much, Chair. Dr. Salihin, I wanted to ask about some of the policy reforms specifically on house building and their impact on growth. And the OBR made their assessment of the house building policy changes to growth by looking at the overall grey belt land, so land capacity, but then also supply of labour in terms of the construction sector. But they didn't think that the government will meet its target of 1.5 million homes. And they stated earlier today, well, my interpretation is that the rate limiting factor is the construction sector. What's your assessment of the construction sector's ability to step up in order to meet the government's house building targets?
I think in terms of what I've seen is that there's quite a lot of there's skepticism about whether they will be able to meet it in full for, as you said, skill shortages. Have we got enough people in the construction sector? We know that a lot of people are going to be retiring, and have we got that expertise? Where does it come from? Would that be crowding out some other private sector investment? So there is some skepticism on whether the numbers will be reached or not. I think in terms of the estimate of how much it will actually impact growth rate, so when we've looked at some of those numbers, we get a slightly lower number. I think the OBR's estimate is 0.2 on the level of growth, and I think our numbers are like closer to 0.1. So we're a bit more cautious on the impact of that and whether it will be as big as we think, and obviously given the skill shortages as well, will we be able to meet those targets?
And which elements are reducing it from the OBR 0.2 to your 0.1?
So I think some of it will be the skill factor, that have we got that, and then I think also the pace at which it's going to rise. We've seen that pace of rise, we haven't seen it, so I think it's just being more realistic given historical evidence on what we've seen. So it uses, these models would use historical data to project that forward. So that's really the source of it.
And what are you basing your assessment on deliverability or on the timing?
So I think we're just basing it on, what history would project forward. So we're not sort of saying, oh, we think this is feasible or not feasible, from the point of view of talking to construction. It's more that it's a gradual line. That's right. We just put it in more in a formulaic way to see what type of effects we would get on the long run, rather than really looking at actual figures.
Thank you, which moves neatly on to Ms Curtis. Your estimates were 0.06 on just based on new targets going up to 0.13 if you tilt towards travel to work areas, and then 0.14 if you tilt towards cities. What can you identify that drop off from the OBR's forecast? And I think in terms of the timing of the report, you might not have been able to consider the National Planning Policy Framework.
Yeah, so I think we're talking about long-run effects, but you're right to say that our estimates are somewhat more optimistic than the OBR's in terms of the benefit you might get from the planning changes. I think there's a separate judgment that the OBR then have to take about how much of that effect is additional to their forecast, and that's not something that we consider. And so as we were talking about earlier, they've already got a sort of macro view on productivity baked in, so they're almost having to judge how much of this reform is additional to that, whereas our report is about the kind of total effect.
And just on a distribution analysis, there's many families that are not in the right type of accommodation for their own income, so perhaps people who are paying private rent levels but that's disproportionate to what their actual income is, and they would really need to be in affordable housing. Have you been able to do any distributional analysis of the impact of house building?
That's not something we've done. That's a really interesting suggestion that we will have a think about, and I think it was also welcome to have in the spring statement, or announced a few days before, some additional funding for affordable homes, and how many of these 1.5 million homes in the end are affordable homes will be really important to the distributional effect.
Dr. Salehin, have you been able to do some thinking about distributional effects?
We don't do distributional effects, but I think in general I would say this is a growth enhancing policy, right? It's good news because it does allow us to have, people, the mechanisms are you have people who can be closer to the work areas, and so it's good news for raising productivity and GDP. So I think overall I would say it's really good news. Whether we can actually meet exactly those targets or not, it doesn't maybe matter. It's the policy is in the right direction.
Mr. Johnson, would you like to make any remarks on the positive or negative impacts of the house building and growth?
Yeah, I agree with the government's view that this is a very important contribution to growth and a really important problem that we've faced. I actually think they've not gone anywhere far enough, quite honestly. Instead of building on so-called grey belt within the green belt, which just might have to be an old quarry somewhere completely useless, they should be just looking at building around commuter stations that have got quick links in, and probably moving to a zoning system rather than leaving still quite a lot up to local plans, large numbers of which don't exist. So I think that it's further they could go, but credit to them for doing what they have. It's really important the homes are built in the right places where there is big demand. Oxford, Cambridge, around London, these sorts of places, Bristol, you can see it in the house prices, which are just way out of kilter, and that needs to be really focused on those kinds of things. It's worth saying in terms of the targets, the OBR numbers are a bit further off than they look, because the OBR is talking about 1.3 million across the UK. The target's 1.5 million in England. So I think there's been a little elision here, shall we say, in some announcements. But the general direction is definitely the right direction.
Thank you very much.
Thank you very much, Ms Blake. And I thank our witnesses very much indeed. We've had an interesting session and learnt that compared to other similar economies, the UK's productivity hasn't recovered since the pandemic. The UK is an outlier. The OBR's forecast could have been much worse, incorporating market consensus on growth, impact of tariffs, and not increasing productivity growth assumptions. So, every forecast is slightly different, but there are upsides and downsides depending, I suppose, where you're sitting on this. And while the fiscal rules are important, it's not the only metric for markets. The number of gilts the government needs to sell and the path for economic growth is also important. So that's quite interesting to hear your take. We talked to a lot of public sector people, Dr. Salaheen, so it's quite interesting to hear your take on that. And of course, the welfare reforms, we hear from Ruth Curtis, look like ways to save money, not so much to get people back into work. And I think your highlighting of the fact that the £1 billion for getting people back into work falls into the last year of the forecast, which may well be after the general election, is quite a salutary thing. We have, of course, the Chancellor in front of us tomorrow, so your comments and thoughts have been helpful as we prepare to ask her all the important questions about the spring statement. So can I thank Paul Johnson, his last appearance in front of this committee. Maybe we'll have you back.
You're welcome to ask me again.
But last as Director of the Institute for Fiscal Studies, because he certainly won't be doing that any longer. For Dr. Jumana Salaheen and Ruth Curtis, thank you very much indeed for your time. The transcript will be available on the website uncorrected in the next couple of days. Order